Welcome to Bravisa Temple Trees market update. First, the good news. After having been down for 4 years, interest rates began to tick up this week. The comments that followed from RBI after the announcement took the markets by surprise. When interest rates go up, markets tend to be weak, whereas now markets have been going up. Why is it so? Markets expected a three-stage hike in interest rates, where guidance showed that it is not going to happen immediately. Interest rates, not in a hurry to move up, brought cheers to the market. And along with that, the expectation of good monsoons this year acted as a booster to the markets to go up. In the last 4 years, when the interest rates were down, industry should have flourished well, while in actuals it did not. Rather than having a big growth, we had a lot of pitfalls. Our banking industry is almost in shambles now, which is showing that industry did not benefit from the falling interest rate. So, what went wrong? Most of the failures were from our over enthusiastic promoters who took the banking system as well as the funds for granted. Just because they had a dream and the clout to get loans, they thought they can run any kind of businesses. Our banks happily lent to them huge sums of money, which otherwise would have meant the bank staff to do a lot of appraisals to dish out the funds what they had in the banks. The end result, both failed. It is actually good that this change has happened because weeding out problems is required for a healthy growth in future. With interest rates going up and companies not showing healthy signs of growth has becoming a big challenge for the ruling BJP in the next upcoming elections. Though crude oil and currency have cooled down a bit, it is likely to go up again before having a bigger correction and a down move. Until that time, pressure is going to stay. There are reports in the media saying that duties on oil products are not likely to be brought down because the flow of funds have already been committed to the projects on the infrastructure growth for the country. On the other hand, oil companies could not absorb the price rise too because all their reserves and loans have been already committed for their expansion projects. So it is going to be a challenging situation for the country now, and every challenge brings in new solutions. So we can expect some dramatic changes happening in our country, and that will be good for the country too. In one way, it has become that by paying more for our fuel consumption, we are indirectly supporting the growth of the country. Now, coming to the bad news that shook the markets this week. Exchanges bringing in restrictions in the form of additional security margins for stocks that have had extended valuations on their prices in the mid and small cap space brought in huge swings in the market this week. This action shook the sentiments of all kinds of investors, both good and bad. Good are the ones who invested based on the company's visible growth using their balance sheets and price strength. Bad are the ones who borrowed the stocks of these companies to take advantage of the price strength and speculate. Mutual funds and portfolios which had exposure to this 100 plus stocks which fell into the restricted category saw huge erosion in their values. Some of them, including us, have begun to liquidate or move out from those stocks, these restricted stocks, even though their fundamentals are strong. These kind of actions are bringing in negative sentiments into the market, which will take a lot of time to recover. Following the caution that we gave in our previous report, some of the follow-up events have been strengthening the expectation that 2018-19 will be a flat year for the markets. With the markets at their historic highs now, it is right time to review your portfolio, move out of those that are underperforming, reduce exposure to equity and allocations, add allocations to debt side, and be on the watch for the next big opportunity that is likely to come in the early 2019. For those who have invested into the balanced category of funds like the dynamic asset allocation, balanced advantage funds or equity savings can stay invested because these funds self adjust towards the exposure on equity and debt, and they are also tax efficient. Once in a year, it is good to review your portfolio, and this habit will ensure that your money is invested in the right place and bring the best return that is possible. Thank you.